Good afternoon, everybody. This is Jeff Scott. This is September, I guess today's probably the 2nd, but I did prepare this last night on September 1st. Happy Labor Day to everybody. Either if you have a job or used to have a job or want to have a job, I guess it's for all of us to celebrate. Try and make this a short one today, but everybody knows I say that all the time and it never happens. So I titled today that, so this is what a correction feels like. September is a bad month. I advise you to take a look at Ian's blog that he posted last night, outstanding as always, talking about his canaries and what will be the final, I guess, shot to prove that this is could be a substantial leg down. Those who know me know that I'm sort of an eternal optimist and a bull by heart. And I saw a lot of conflicting things as I looked at the market this weekend. Let's go ahead and let's get started. Of interest, the futures are up over 14 points, the Dow over 100, the NASDAQ over 30. I looked at this last night when the futures opened up big. I don't know if it's because of the waffling by Obama and perhaps the feeling now that we're going to put off a Syrian attack, or perhaps I'm just making up more out of nothing and it's just a resetting of the contract month in the near time. But regardless, the futures look positive, but we've got a whole day for the world to blow up. My contact information is there. Disclaimer, this is for educational purposes only. Any recommendations are in the spirit of education and should not be considered investment advice. I'm a doctor, not a broker. I am truly independent. I do not own any companies that are trying to sell you software. I have paid for the things that I use, and I do these recordings because it forces me to follow a trading plan. I do promote things because I want to, of things that I think are important, and we've got about a month to go before the HGSI workshop in California, October 26th, 27th, and 28th. Actually 2 months, great meeting, best meeting I go to. I've been going to it twice a year for a decade or more. Ian and Ron put on a great show. They feed you, they water you, and all you ought to do is pay for your housing and one dinner in addition to the cost. There's a deal at the Courtyard Marriott, Palos Verdes, Torrance for, I believe, $100 a day. If you're bringing your spouse, there's a great resort called the Terranea. Not up here, because I didn't prepare for it. I forgot about it. On the October 19th, 20th weekend, there'll be a meeting in Orange County that George Lee is putting on that I'll be speaking at. Next week, I'll actually put something up about that. Greg Mills is the sponsor of that. Agenda for today, my typical weekly 30-minute review. I guess it's not intra-week this week. Things I watched during the day, and again, I welcome you to email me with questions, answers, stocks to look at, suggestions for improvement, or even attaboys. As I put last week, is this market topping or just pausing to refresh and back to a bull run? Topping, seasonality, September is bad. We've had a bunch of Hindenburgs. The bulls are long in the tooth. Easing is coming to an end. Interest rates are rising. Housing is, appears to be weak. I don't need to say anything more about congressional and presidential leadership. Some leaders have been whacked and divergences have been abounding. Or is this just a pause to refresh? Last week, I said the major indices look to be holding at the 50-day smooth moving average. Well, I guess I can go back in here and almost take that one out because I don't think that's the case anymore as they got whacked, all except for the small stocks, which are the last ones to hold on. Our interest plays back in vogue. Have rates dropped? I think this was actually not a bad pickup because when I looked at some of the strength last week, some of the dividend plays did seem to do better. And a number of utilities, of all things, made it to my review this weekend. Are we getting rotation to new leadership? I think we've seen that clearly. And at the end of the day, reducing QE is not the same as raising interest rates. The software, I'll go into it 1 second, and then we'll get on with my review. Actually, cancel that. So www.highgrowthstock.com. And just a couple of quick points. I'm not in my account, so I'm the same account that you would have when you opened it up. Free 30-day trial without a credit card. If you download it, you need to go to support, add-ons, and in add-ons there are two files that you need to go and put into the program. Download them and run them, and then both of them, and then restart HDSI. It'll happen automatically, and you'll have the same views, screens, filters that I have. As I mentioned, mentioned Ian's blog can be found right here. Ron Brown on his blog has frequent videos talking about the program and the market. And then I come up and I do these on a weekly basis, and I plan on posting some buy lists and also doing a model portfolio when some of this market volatility shakes out. I don't want to be like there's a Mike Ryan, Pat Ryan, O'Neill's money manager, who's just had a great multi-year run. And by the way, he came to an HDSI meeting as that multi-year run started. His initial couple of years were down, showing the difficulty in starting a portfolio in a market of volatility. There's also a great forum which you can learn about on the community button. As I mentioned, futures are continuing to rise. They're very strong for whatever reason. I'm always suspect, but you could see Asia had a great day last night, and it looks like Europe is having a great day, up over 1.5%. I try to find out reasons for it, and I'm sure I'm missing the obvious. I suspect a lot of it is due to the waffling here about the Syrian attack. September is a bad time typically. Remember, Asia and Europe have to have another day before we run our market. It'll be interesting to see if these futures can hold. So everybody knows I like to look at the market to start, so let's very quickly take a look at the market and see if we can make any comments. I usually want to look at just three. Let's look at the Dow, NASDAQ, and the S&P 500 using my elder indicators on TradeStation. There's Baidu, potential short perhaps if the market rolls over. So here's the NASDAQ. Take a couple seconds. I have a lot of things running, and although I've got good internet access, it's not great internet access since it's Wi-Fi and not a hard line here. All right, you can see the NASDAQ, which was one of the lone holdouts last week. If we go back 5 days, 1, 2, 3, 4, 5, the NASDAQ was still green while everything else was red. Well, the NASDAQ has rolled over, and as you can see, the NASDAQ is red. Red on elder means you can sell or you can hold, but you shouldn't be going long. I've been concerned about the divergence, and that this high here was accompanied on a much lower MACD histogram, and this high here to a higher high barely made the positive range. And so that to me is the divergences that I've been very concerned about, and I'll remain concerned about as potentially being something to be careful of, and indicators that this market is not very strong underneath. That was the strong market, frankly. The S&P 500 and the Dow are even more moribund, perhaps is a good word to use here. If it takes too long, there you go. You can see, although the S&P has pulled back enough to it's at a point where the elder impulse indicator might suggest that it's perhaps more neutral. But you notice the NASDAQ was still up in the middle of the channel, and the S&P 500, although it is blue, which is a better sign than red, is much further down in the channel, indicative of the fact that the S&P 500 has had a more substantial of a pullback. If I look at the Dow, I suspect I'll see the same thing. Notice on the S&P, the weekly was red, the monthly was blue. Let's see how long it takes for the Dow to pop up. My problem is, as you see, I've got a bunch of workspaces, and every time I switch, they're updating all my workspaces at the same time. So the Dow also is blue. Again, blue is better than red, but look where the blue is compared to the NASDAQ, which was the last holdout, although it sold off quite a bit. You could argue that the NASDAQ, to catch up, has a lot further to fall. So if anything, this tells me it's caution time in the market, caution to bearish, but I'm going to trade the market I get. not the market I think I should get. And right now the futures are pointing higher, but as Ian says in his blog, the market is extremely news-driven, and it may be that that's the only thing that's going on is the news. So let's see if I can. All right, perfect. Now I also like to look at mathematically how the market did last week. So I think I call the end of week review. So the first thing is in HGSI, I can run all my different watch lists and look from week to week and get an idea of performance, compare them to the S&P 500 and to what I did, and get an idea of not just how I did in the market, because it was a shitty week, excuse my French, for everybody, but unmanaged, if I had the same stocks on this Friday at close as I did at close last Friday, which is not the case, but everything else is fixed, so I can't change mine as I manage it. How did I do? How did the market do? So the first thing you see is the S&P 500 here was down 1.84% from Friday close to Friday close. So that should set a tone that this was a negative week. That's a really negative week, and I'm sure most people experienced it. No surprise that when I picked my leaders to look at for the week, they were down 2%, consistent with the S&P 500. The IBD 50, a smaller number of stocks, did a little bit better, minus 1.43, and the HGS 100 did a little bit worse at minus 2.17. I think reality, they're all about the same. Now, what I thought was interesting is the Bible gap ups that I picked up in TradeStation. So I have multiple Bible gap up screens. For the most part, they're similar stocks. This was actually down worse than the market. So I think, one thing that I've learned over the last couple of years is that things that are highs or breaking out sometimes fall the hardest when a market crashes. And you can look at red candle highs and think about what these are. These are stocks that Monday traded above Sunday's or Friday's close, but closed down for the day. And so they were stocks that had failed new highs, and they did some of the worst performances, minus 2.88. Those stocks that had a red candle high at the high jump, and I mentioned last week that that's one of my shorting scans, looking for stocks that are failed new highs and are up against the high jump, or perhaps I might look up against a major moving average, and they were down 7%. Now, interestingly, this week, things off the bottom didn't work, although there weren't a lot of stocks there. They were down 8% as well. My holdings, I feel the champ, because I was only down 1.3, but it was a pretty lousy week. Again, I have a mixed portfolio, long and shorts, and I don't maintain the same portfolio. What won? Interesting, the leaders, which is a smart group for the week, was up 1.36%. Strong EPS near 52-week high was up 0.63%. Not sure about this smart group. Short supply, short-term negative earnings growth was actually up 0.61, but most stocks more were negative. High ERG, strong EPS relative strength were up 0.54. Squeeze, growth, 52-week highs. These are all being run last Sunday. QuEPS. A lot of these are the groups that I use in my group inclusion filter for those who've been here before. Bucketology, this is a great tool that Ian came up with. And Ron, don't want to slight Ron, not knowing which one put in more of the work on it. But basically, Bucketology, let me see if I can find what I'm looking for here. Bucketology, here's your little bucket. You can take the lower band to the upper Bollinger Band, divide it into 10 groups. You have one underneath and one above it. That's 12. 95% of the time, the stock's going to be between the lower and the upper band. In a bull market, between the middle and the upper. In a bear market, between the middle and the lower. When too many get above or too many get below, they have a tendency to go back the other way. So I look at the Bucketology to see two things. Get an idea of where we are, and 88% are below the midline. That tells me we are very deep in the bull world. Now this can change over a matter of days to weeks. And I see that we're starting to get heavily weighted to the left. And when this happens, I'd like to see us above 25 or 30 to really know for sure. But we're getting to a point where we have a lot of stocks that are very oversold. And when you get a high number of stocks in a place that they're only at 5% of the time, they have a tendency of correcting back towards the center. So we might be getting close to a bounce, but by no means is this a clear indication. On a positive note, we had our 4 or 5 Hindis that occurred, depending on which way you're measuring, back a couple weeks ago. The last Hindi was on the 14th, and you can see we have not had a Hindi since. If I was to take you back to 2007 and 8, and let me do that very quickly here because I think I've got it in a PowerPoint, which is actually easier for me to show you. These Hindis are, I think, maybe 1 out of 4, 1 out of 5 is working. They become more important when you see series of them. So this is 2007. We had a double top. We had head and shoulders and a lot more than a double top, depending on how much of a technician you are. And you could see these red lines gave us a volley of them. And then from the bottom, the November 7th top, until August of 2009, you don't see one of them. So these, when they occur are concerning. When you see a series of them, they're very concerning. We seem to have escaped them for now, but there has not been a major correction in the last 30 or 40 years that has not been accompanied by some Hindis. So I'd be concerned that we saw the Hindenburgs. I'm a little bit relieved that they seem to have stopped, but if we have another run-up and we start to see Hindenburgs again, I would think of that 2007 slide. Let's go take a look at the market. I forgot to put something in there. All right, so we'll leave that for now. So let's open up HGSI. And let's go, I start off usually in the warehouse view. I have a lot of things open. All right, there we go. And I'm going to go into, well, first of all, if you've downloaded all those user groups that I showed you in the website, the add-ons, your reference groups are where all your standard things are updated automatically by the program, including splits and changes in component makeup, ETNs and ETFs, and indexes. Smart groups we'll look at later. These are pre-planned scans and searches that are done by the program, and you saw several of them were my better performing groups for the week. And then the user groups, these are things that you put the stocks in the folder or you import them into the folder, and the stocks don't change, but they get updated. It's a great way of tracking things. This is the latest Woodward & Brown user groups that I'm using, and those are what you'll download. I go to Major Market Plus, top-down analysis, and I see where the strength of the market was. 20-year Treasury bond iShares was the strength of the market. So I guess bonds go up when interest rates go down, and as I noted last week, I saw some improvement in the interest rate sensitive sectors. You can see that the indexes themselves are at the bottom of the list, showing weakness in the stock market and the small caps starting to catch up with some of their larger brethren, which had led to the downside. If we look at 5-day performance, we can see our friend the VIX had the best move, up 21%, and we can see transports down 3, mid caps down 2.8, small caps down 2.6 or 2.7. The NYSE, which is a lot of different things, down 2.2. The S&P 1500 1.9, and the Dow was down only 1.3. So the big stocks, as you can see, turned to blue on the elder indicators because they actually started outperforming. I like to look at some of these to get a flavor of the market. It's going to be redundant, so I may not look. I'll probably look at them all, but I'm going to look quickly. The S&P 500. I did an analysis over the weekend. See if I can. From April of 12 to now, there were 23 swings in the market. So the swings were short. Okay, I'm going to turn off TradeStation because it says my audio quality is getting worse. All right, so that should help. And you know what? I'm going to turn off my Thinkorswim as well, so that I'm not drawing anything. Perfect. All right. So there was like 24, whatever number of swings I just said. The average swing looked like it was 5 to 7 days, was 3 or 4%. And if you look at where we are in the market right now, we are in the midst of another one of these swings. And so if I open up, perfect. Let's draw these in red from top to bottom. The swing was 18 periods and down about 5%. The last swing down was probably the most dramatic. And from top to bottom, it was down in the neighborhood of 7.5%. So we've had a series of these swings up and down, but despite all that, we've continually rebounded, and this was a recovery in 28 days of nearly 10%. And this has been the pattern that we've had over many, many months in the market, going back a year. And you could, so here's the low at 09, but I started looking here in April 2012, and you could see a series of pullbacks. So we had a big run-up, then we had a pretty dramatic pullback here at the end of last year. And this was kind of interesting as I was looking at it, about 9–10%. Then we had a run-up into middle of December of about 8%, and then we pulled back and we bottomed on December 31st. And that's when we woke up on the 1st or the 2nd. There was some compromise in Washington. The debt ceiling was raised. Some of the tax things were kicked down the road, which is what this Congress does. And we've had a very nice run since then. So the question remains then to me is this the same story and we're going to bottom here and go back up? Or are we going to come down here and visit the 200-day moving average? Now, we haven't had a robust correction in some time. And I think that one of these days we're going to get that more robust correction. Or are we going to just motor back up from here and go out to new highs? When I see the divergence in the market that I showed you on TradeStation, there's a lot of divergences there. I'm concerned that we're going to get that pullback to the 200. The time of the year is correct, being September. But this is news-driven. And if tomorrow the Fed comes out and says we're not going to cut back in September because the numbers are not supporting it, and Congress says we're not going to drop any missiles on Syria, maybe we'll do a little bit of coastal blockade, which doesn't hurt anybody but starves them slowly, the market will shoot up a big movement this week. So you have to play the market we get, not the one we think we have. We are due for a big, deeper pullback. This is the right time of year for it. We'll see if we get it. We look at the Dow. I mentioned the Dow is a little bit stronger this week. And you can see a similar pattern, the Dow having much deeper pullback, starting to bottom here, still below the 8-day moving average. You had the 17 cross below the 50. Everything red in the momentum indicators. That's obviously not a good thing. If we take a look at the NASDAQ, this was holding up, but it was down lower on the list this week, and you could start to knife through as well. So the NASDAQ is at a pretty important point here. It has not broken the 50-day moving average. It certainly looks the strongest of what I've shown you thus far, and I think a lot of what's going to happen is what happens if the NASDAQ can hold and go up here, and a lot of Ian's Canaries are big NASDAQ plays, then we might see this market start to recover. And I think if I was trying to figure out what I was going to do with my portfolio, I'd be watching a lot. That's my line in the sand. A decisive break of the 50, and I think it's over for now. And I am concerned that that's where we're going to go. The other leaders have been the small stocks. Sorry, I didn't want to. And we can see how very much, a little bit, here's where I get nervous. The NASDAQ has, is above the 50, and we're going to wait and see. Last week I had the same comments above the Russell. And I think this is faint, Let me draw it in blue. But it looks, in my mind, we had multiple days of support there, and I think we broke through that support. So it'd be interesting to see if the Russell can rebound, obviously with the futures as strong as they are. If it holds through tomorrow, I mean, maybe we'll get a snapback and we'll see the indices recover. But I'm very nervous. I think this seasonality, et cetera, long in the tooth, all the reasons why I gave, I'm concerned about. I think the risk favors a correction. If you don't believe the market is weak, you can go into the broad market indices. Now, the first one, the major market plus, these are actually downloaded from the exchanges. The major market indices are calculated. Since they're calculated, we can do other things with them. So let's take a look at S&P 1500, which is in here somewhere. And you notice it gives me volume, which I don't get on the provided index. And let's go and let's look at the eye charts. This is something that Ian and Ron use a lot, and I think they are very helpful. You can see in the first eye chart that everything, the bongos and the force, have turned red. And this is not pullback red, which is green long-term and red short-term. This is red for long and the short indices. If we look at the directional movement, we can see that the negative, DI negative, has crossed above the DI positive. That's not good if you're long-term. What else do we got? The second one down looks at new highs and new lows. And you notice that we've got a red bar showing here. And if you look, so this is plotting the highs versus low and their 13-day exponential moving average, and it's about to cross below, which would be a negative thing. Here, if the new highs, new lows are greater than 0 but less than 65, then you get a dark green. If they're greater than 65, you get light green, greater than 65, you get dark green. And if new highs are less than new lows, you get pink. And you can see we've now flipped where new highs were less than new lows, and you can see in periods of market strength, you get a lot of dark green. You certainly don't see pink. We've been in and out of this pink for some time. Another thing to look at is to look at accumulation distribution. And dark green is A's, and you can see they're almost hard to see them exist. B's are on their way down. E's are heading up. D's are at the top, and L and C's are in the midline. And you can see that the price has crossed below the 22-day exponential moving average, which is important for the Elderites in the crowd. And you can see the E accumulation is above the A accumulation, all showing weakness in this index. If you look at A plus B versus D plus E, you see the D and E's really taking a lead here, again, emphasizing the weakness in this market. If you look at 5-to-1 days in either issues or volume, you can see we closed the week with a 5-to-1 down day for a number of advanced decliners. That can't be good. If you go back to, I think, Tuesday, you can see a 5-to-1 day on both advanced decliners and volume. So very bearish signs as we drop below this 50-day moving average. And if you look at those stocks trading above their 20, 30, 50, and 200-day moving averages, and then you plot a 20, 30, and 50, and 200-day moving average of that line, you get a sense of whether most of the stocks are above or below that moving average. And you can see that the markets as a whole are trading out below their moving averages, which is, again, another bearish sign. It would be nice to see this start to move up, which could be an early sign of a market bottom. But you don't get a lot of uptrends when these are falling. You don't get any uptrends. Eventually, they'll stop falling and move up. So if I haven't convinced you, let me just say it. We are at a very risky point in the market. I almost sense that the internals are much weaker than what I saw in my portfolio and in the stocks that I look at. And I think it just has to do with some rotation, and that growth stocks over the last several months have been outperforming. But even then, even those growth stocks this week had a rough time. If I go down to industry groups, you see we have 146, and I want to know what's working right now. We look at the 2-day force. Here's what I knew it's going to be a short review. We only got 7 groups that are positive. That's an all-time low for me, or getting there. Also, I saw very few stocks that were both daily and weekly bongo green. I saw very few sprinters. So a lot of my scans were at uncharacteristically low numbers, which suggests a couple of things: a narrowing of the leadership and potentially getting closer and closer to a bottom. So we can look at these very quickly. Casinos have been strong. Now, I should have had this stock. I've been in and out of it. I wish I was still in it. MGAM was up for the week 5% in a very bad market. Now, I own a number of these, which is kind of why I'm out of this one right now. This has been a good place to be living in the casino world, especially if there's a Macau presence. This is getting a little bit extended, but it had a kahuna on Friday with a pocket pivot, big bullish day, everything is green, and it makes money. Don't know what's going on news-wise, but this is what a leader looks like. So this is one of my leaders, extended and probably gone. Higher risk to buy up here, but that was a very bullish day, and it might turn out to be a good thing to buy up here. I normally only look at stocks that are trading above their index, but a couple that I own are below it. I own MPEL, which is all about Macau, and it's in a nice run. It's got great earnings per share growth, not near the top, going sideways here. If I could see a kahuna or a pocket pivot coming in now, I saw one on Thursday, I might get excited as an add to point. And then one I don't understand, but I bought because of the momentum, has been Caesars. And it doesn't look so hot. It had a shooting star on Friday, but you can see it had a very nice move up here. I'm fat with profits on this one. I don't get it because it doesn't make money. There's more to the story than just earnings here. And then I also have a position in Las Vegas Sands. So I've been very heavy on the casino stocks. That doesn't look as impressive. It's one of my longer-term positions, but you could see it's been a very nice uptrend from 33 to 57 over the last year. So casino stocks are the strength of the market from a top-down perspective. Let's see what else we might find. We have multi-line insurance. This is one company, HCI, smaller stock, and it's certainly an HGSI type stock and an IBD 50 stock, and also one that's been in and out of my portfolio. It's had some rough times. You can see accumulation distribution was a D, but you also will hopefully see, if I can actually go to the right place, that it had a major big day on Friday. So if this market was to go up, IF being large 2 letters, you had a bottoming position here, you had a gap up with a kahuna, huge volume, and a viable gap up here, makes money. I think that's a very interesting looking pattern, and I would set my stop somewhere close to that 50, because if it dropped below the 50, I don't really want to be in it anymore. I'm buying it because it's breaking above the 50. You could also stick with your stop, and there's a lot, that's only about $1 difference at the bottom of the gap up, and go by Morales and Catcher rules. That was the only one in this category, but that looks, if you want to go long, that looks interesting. Specialty stores, this is a big hodgepodge led by Zale Corporation and Tractor Supply. We'll take a look at those two. Obviously a very bullish, this is one of my favorite patterns. Big run up, sideways, really sideways for 2.5 months, and then you had volume and a kahuna come in and a viable gap up, must have been on earnings, into the races. Look at the earnings per share growth coming into the stock. That's probably the Christmas season. But this looks very interesting. And again, if you're looking for a cheap retailer, here's your Bible gap up. Looks strong. If this market goes forward, this will probably do very well. And there are rules about buying Bible gap ups. Track supply, Fred Richards Holdings. I'm not sure if he's still in this, but knowing Fred Richards, I'm sure he is because he doesn't seem to sell great stocks ever, or at least until they're done being great stocks. Here was a pocket pivot on Thursday, gave back some on Friday, but a very positive week for Tractor Supply, one of the great retail for the farmers. All right, this is not a lot of excitement here today, folks. I only report on the market. I don't make the market. Ghilardi makes the market, but, you know. Drug retail, Walgreens and CVS. Walgreens is an interesting story. And you could see the red on the Force Index 13-day. So these are stocks that have been downtrends. And you look at the accumulation distribution sucks and D&E. So this goes along with market rotation picture. Probably, nope, it's coming. You know, it's below the 50, maybe bottoming here. I mean, this is what happens when you don't have anything that's doing well. You get things that don't look great leading. I like to see it get above this congestion area here. I'm not going to say anything positive about this except it's got pretty good earnings per share growth. Twice its multiple. Maybe this is a good time to get in. Just to give you background, Walgreens recently did a deal with AmerisourceBergen, a major drug distributor that gives them the ability to buy up to about a third of the company. Most people I talk to on the street thinks that Walgreens will be buying all of Amerisource. So if that's what I'm hearing, then it may be baloney, but then everybody knows it. So that may be an issue on the stock going forward, but it's trading at a big discount to its earnings per share growth rate. And CVS is the other in the group. Clear some of my memory. All right, here is CVS Corp. And CVS Corp looks somewhat like Walgreens without the earnings per share growth. Pull back, looks like it wants to set a bottom here, but it's still got to get above a lot of these major moving averages, so I'm not real optimistic there. Let's go back. Wireless telecommunications, this will be big on Monday because Vodafone is selling out their share to Verizon. You can see that's already in the stock. Now some of these are interesting. I want to take a look at a couple because they some pay dividends. Again, Vodafone is a number there. It'll be big on Friday because of a large back shares by Verizon Wireless. I think this will free to go up. And you can see this was stuff that was talked about at the end of last week with a number of pocket pivots, a Bible gap up here, a Kahuna, tons of volume. Don't know how much it's all priced in, but when you get billions of dollars coming in, it probably inflates your price up a little bit. See if anything else looks good in the sector. Below the 200, but bounced off the 50. It's still churning in there. Don't know much about this guy. All right, here's a guy that's gone from 17 up to 21. Looked good on Friday. Everything is green, but it doesn't make any money. I don't know that worth it. These look like a bunch of international wireless companies. Maybe they all go up, rising tide with the Vodafone acquisition, or Vodafone sale of their position in Verizon Wireless. IT consulting. Fleetmatics has been on the list frequently. You notice there's green there all over, and accumulation distribution are A's and B's. Fleetmatics doesn't have an EPS rank. It's probably a newer company. Let's just see if there's anything there that looks interesting. Sure, pull back to the 17 and running. Everything is green, makes money, new company, certainly extended. You can see what happened the last time it got extended. It does what extended stocks do, is it pull back. Extended stocks do. I'd probably be a little leery of getting into something that's this extended. Carbonite, don't know anything about them except they're always advertising to store my stuff online in the cloud. Doesn't make money. Chart looks like it's breaking out. Inside day on Friday, do some research. That's an interesting looking chart pattern. I mean, this is what I do, and right now it's not being very exciting because it's a tough market and I don't see a whole bunch of leaders breaking out. Lastly, cable and satellite. And here's a stock, Dish Network. Everything green, accumulation distribution B, 2.7 million shares a day traded. For a stock that is a leader, I think this was one that's giving you a lower left, up to upper right. It's pulled back to the 50 where it had a pocket pivot, broke above the 8 and the 17 day. The Bongo Daily is still red from this pullback. It'll probably revert once we move up a little bit. Doesn't make a whole lot of, no earnings per share growth, although it's profitable. All right. So if all these groups are to the downside or to the upside, then that probably tells me when I look at force up on the indexes, or force down, I should see a whole bunch, and I do. And you can see a lot of our usual standouts: internet, retail, semiconductors, biotech, regional banks, oil and gas plays, at least some equipment and refiners are here. So I'm not going to go through many of them. Go through your own. Clearly, when you see 5 or 6 groups to the upside and 69 groups to the downside, it is not a strong market, or it's one that's pulled back hard. This can obviously change over one day. So let's look at some of the bottoms up things that I do and see if we can find anything else to look at. So one of the first things I like to do, and I do this on a daily basis, is I go into all securities and I go up here into my HGSI strategies. I'll go into the same one you have, top-down investing. I go into Woodward and Brown archive. I go down into reference library. I find miscellaneous. We should have just called this the Gallardi scan. I go into Sprinter One Step with Bongo. And the first thing I see is I got 34 stocks. 34 stocks. That tells you how few stocks are leading in this market and breaking out. These are the best of the best if you want to do a simple test. And usually week in, week out, when the market goes up, these stocks lead. Now, one thing you might notice is we've got a bunch of biotech stocks, yet most of these, we do not see biotech on the top-down approach. Now, you can see that the Force Index 2 days is down on the majority of these stocks, so they're all in a pullback, at least by force. So we'll have to see, but several of these, BioCryst has been a great performer. Gilead, Ligand are stocks that I'm very interested in. Multimedia games, we didn't look at Century Casinos that made this list. I've got internet software services. I got several. I've got several IT consulting and other services. We just looked at those. And a couple of big pharmas. Acorn had an acquisition announced this week. And Qualisys was one of the top-ranked HGSI stocks. And Goodyear has been a great performer for me, although its earnings per share are starting to slow down. So I might look for any ponies here or wolf packs, and I see a couple that might be interesting. And I do like to look at these from a top-down perspective, or from a chart perspective. This is not top-down, this is bottoms-up, so I'm going to look through a couple of these real quick. Although whatever's going on my computer today, nothing is real quick. Let me shut down all trade stations. They've just turned off. Exit. Maybe that'll free up some RAM. I don't need my Excel anymore. All right. So we've already looked at multimedia games. Let's start then with the second one on the list, which is K-12. I did note, I've been burned by these online education companies so many times. A little bit faster. So let's just take a look at some of them. This is K-12. Ian once taught me, when you see kahunas marching, pay attention to a stock. Everything is green. Bible gap up. Tons of earnings per share growth. Something is going on here. I'm going to add that group to my buy list and watch it during the week and see what's going on there. Boy, my computer is slow. This is when it's time to do a reboot. All right. Goodyear, I've owned it for a while. I owned it because I was enamored by its earnings per share growth that were coming into a stock that was a perennial loser. It's had a big run from 12 up to 20. Had a sort of a bearish cloud looking candle on Friday. I've got stops that are set, I think, around the 17-day moving average. We'll see if I get stopped out or if I hold. Nice run up. Casinos, this is another casino stock. I don't know this one. So it's a cheapie. It's a $5 stock. Pull back to the 8-day exponential. Everything is green. It makes money. If you're not in casinos and you want to buy something cheap, you might want to take a look at that puppy. Sinovac Biotech. I should know these guys. They're a vaccine company. Even vaccines for infectious diseases, SARS, avian flu. It's a Chinese biotech, so take that into account. Occasionally makes a few pennies, but really doesn't make much money. Everything is green. Nice run. There's been some, whenever you hear about dead pigs or SARS, these stocks go up. Egan Communications. I love the setup here. We missed it. I love the pullback to the 50. Stopped on the 50. Had a kahuna. And the next day, gapped open. The Bible gap up. Everything is green. Doesn't make money, but getting closer to zero. Bertusa Company. Again, another nice pattern here. We've got a very shallow saucer. You can even already a cup and a handle. Now it needs some volume and a breakout, and it runs. It makes money, mostly green. The long-term force is red. So this is what I do, and I could go through this whole list, but I don't want to. We'll look at the next couple. Facebook. It languished for a while. Viable gap up. I think the stock wants to run again. It's got earnings coming in. It's got a lot of positive things going into mobile. It seems to be ready to give Google a run for its money. And this is probably very early on in the lifetime of Facebook from a price perspective. And you can see it's now getting back up to the high area, at least the open on its IPO. And a breakout of here will start to get to the land of lack of overhead supply, and its IPO failures will be behind it. Jazz Pharmaceuticals is one of my holdings, lower left, upper right. It's certainly had a red candle high up near the high jump, so it's at right to pull back. On the other hand, for a pharma company, it trades at a multiple of 17, no dividend. It has a growth rate higher than its multiple. Carbonite we looked at already, story in the cloud. Manintech, what is Manintech? Manintech is a medicine, chemicals, and botanical products. Doesn't make money. Looks like it had, well, actually makes some money, has some sales. Nice run up there. Kind of looks toppy. Let's see where it goes. Volume coming into the stock that it never saw before. That's kind of interesting. So I'm not going to do the work all for you, but one of the things to do is to go into Springer one step into all securities. Let's just close with a group inclusion filter test. So tools, group inclusion report. So the hypothesis here is if a stock makes its way in a lot of strong lists, then it must be a good stock. So let's clear everything. Let's open up the smart groups, which are the pre-run scans for us. In Morales and Catcher, I like Bible gap ups. I like pocket pivots. And in the Woodward and Brown, I like best of. best criteria, strong EPS, relative strength growth, HGS 100, leaders, QEPs, stocks and groups moving to the upside, and strong EPS, relative strength near 52-week high. Many of these groups were actually positive, stocks positive this week, despite the bad market. Top picks, Labor Day, let's look at the top 10 or so. You can get a smaller number if there's a tie. So again, the hypothesis here is each of those groups represents strong groups of stocks. And if my stock ends up in many of those groups, it must be extra strong. That's the hypothesis, and it's one that seems to play out on a weekly basis. So it's running its analysis, and here it comes, I hope. No index needed. So these are the stocks that made it to the top of the list. And then this is another bottoms-up approach versus top-down. Let's see what we find. Let's look at these 10 and say goodbye. So this is top 10 on Labor Day. Here it is. Let's go to scorecard. So they're all here. All right, let's look at these 10. How many of these do you own? I hope you own some. These have been the leader. So this here stock was one of the top stocks when I run the scorecard and most of my views. It doesn't make money, or doesn't make much money, which has been why I was hesitant to show you. Clearly a leader, broke above the 50 back in May, tracking right up on the 8-day here. Not near the top of the high jump, already had a chance to pull back. Everything is green, great performer, and they are in the IT space, if I remember correctly. Homeowners Choice was that small insurance company that had a big gap up, viable gap up off of perhaps a low with a kahuna volume. Very interesting to me. Multimedia Games was that casino stock that we looked at from top-down view, the leader in the casinos, breaking out to new highs. We'll see if it can sustain it. Michael Kors is probably the best retailer out there. It's in my portfolio, lower left, upper right. Its problem in the past was it always performed well, and then it did stupid things. This was a period of time of a great move, and then they come out with a secondary, and the stock sells off. So right now, it looks great, taking share from Coach and others, still expanding number of stores in a nice growth period of time. Pocket pivot could be a Bible add-on point in a week tape on Friday. SoFund Holdings, this is the stock we looked at a couple weeks ago, pulled back, and then Friday off the 8 and 17-day had a Bible gap up with a kahuna, all green. Doesn't look like much there in earnings, but when you go out a couple quarters, it does make money, and this might be an interesting play. Ligand, this is a company that was not great as a medical marketing, but was great from science, so they started licensing out their products, and they make their money when other people sell their drugs. They also have a bunch of royalty payments. They are a part owner of Kyprolis. Kyprolis was the key holding of Onyx that was recently sold to Amgen, setting up a nice saucer bottom, see if it can form a handle on low volume and take off. Red candle high on Friday, worrisome with lots of volume. Then again, Friday was a bad day everywhere and had a kahuna the day before, something to watch. Lionsgate, I wish I never sold this thing. Lower left, upper right, slow mover. Red on the Bongo Daily because of this pullback. I'm looking for a kahuna or a pocket pivot to come in for this thing to be off and running. Stumbled its toes this quarter, but it has had nice earnings per share growth for multiple quarters and has it going forward. Infoblox is one of these companies I don't get. This is another IT company. Little bit of revenue growth, not much in the way of earnings, but a very beautiful move off of a squeeze here with a Bible gap up. Came down, tested that 8, and has run up since. Had a doji with a pocket pivot at a high on Friday. I'd like to see which way this opens. Don't love the fundies. I obviously don't understand the stock because a lot of people do love it. Jazz, we already looked at, is one of my favorite pharma companies. And InventSense is one of my big losers that's turning out to be a good winner. This is a Chris Catcher likes this stock a lot. And once it broke above the 200, it's been in a steady run, up 5 points in 4 months, closing up near 18, all green. They make, I guess, some of the sense of where you are within a mobile phone chips for a lot of the gaming and for motion sensing. And I guess if they're in the new iPhone, this thing takes off. So that's InventSense, and that basically is it. So let's look at what we did today. We talked about the market being in a period of question and concern about pullback, although we've got super strong futures as we sit right now. We looked at sector rotation, and we saw our sector strength, industry strength, and we saw that there are very few strong groups led by casinos, IT, and a couple others. We then switched to bottoms up, and with the sprinters, we found very few stocks, although some very nice looking charts, and we closed it with a group inclusion filter. This has been probably about an hour, and I'm going to say goodbye. I hope everybody has a great Labor Day. I hope I didn't have too many issues with my memory. And I'll do this again next week. Feel free to send in comments and requests for stocks for me to look at. You all have a great holiday, and goodbye.